Hello, I'm Annabel Brody-Smith, Communications Director of the Association of Investment Companies. With Kamala Harris and Donald Trump neck and neck in the race to be the next US president, it's a pivotal moment for investors. The outcome of this election could have significant implications, not just for US equities, but for markets across the world. So far, we've seen the S&P 500 rally by an impressive 21% year to date, which has until recently been dominated by a small number of stocks in the Magnificent Seven, but it's now broadening out to small and mid-cap sectors. Investment trusts in the North America sector have delivered strong performance, 29% share price total return over 1 year, 132% over 5 years, and 230% over 10 years. Yet, surprisingly, they're still sitting on an average double-digit discount of 21%. So what might the US election mean for investors, and can the rally of the world's largest economy continue? Today, I'm delighted to be joined by three managers from the North America and North American smaller company sectors. I've got Gary Robinson, who's the investment manager of Baillie, Gifford US Growth Trust, Sven Anders, who's the US Equity Investment Specialist at JPMorgan US Smaller Companies Investment Trust, and Dean Orrico, who's the Portfolio Manager of Middlefield Canadian Income. Right, on to the questions. Where do you see the biggest opportunities in the US? I'm going to kick off with Gary.
Well, the first thing I want to say on this question, Annabelle, is that I think that the US remains the most exciting market in the world for growth investors. You look at the sort of previous waves of innovation that we've been through in the global economy with the internet and mobile, and it was US companies that were leading the charge with those innovation waves. We're going through another of those innovation waves right now with the emergence of AI and more specifically generative AI. And it's the US companies that are really at the vanguard of this shift again, which I think just highlights this point that America remains the world's innovation cluster. And these are the types of businesses that we're looking for, the companies that are innovating and which have got the potential to grow faster for longer. In terms of where we're finding opportunities, it's very stock specific across a number of different sectors. Companies like Shopify in e-commerce, Duolingo in education, DoorDash in food delivery, Meta in social media and advertising. What these companies have in common is, first of all, they're bringing new technologies to existing industries and reshaping those industries. And secondly, these are founder-led businesses which are more adaptable than average and more long-term than average. And that's one of the things that we're excited about.
Excellent, Gary. So US is leader of innovation. Sven, obviously you're looking at US smaller companies. Where do you think the opportunities lie?
Yeah, I think in general, where we do find the opportunities is in the small cap and the large cap space. I mean, if I think about one word, then that word has to be active. I think if the last 2 years really showed one thing, is that investors wanted to be in the active space. If you just strip out the Magnificent Seven last year in the S&P 500, the rest of the market was up only 8%. So there was a clear indication that you wanted to be in the active space. And that's even more true in the small cap market. We have a very broad market when it comes to number of stocks, close to 2,000 names in the Russell 2000 index. And there are some areas that are really attractive and some that are not. We do focus on industrial companies at the moment, but we also like some of the basic materials. We like some of the financials, even though last year everything was around the regional banking crisis that we had in the US. So I think this year in particular and going into next year is really one market for active management. And we do find opportunities across the different sectors that we have in the small cap space.
Great, Sven. So you're seeing opportunities across various sectors. How about you, Dean? Where do you see opportunities?
Well, as distinct from the other two, we're a uniquely Canadian focused fund. We have the ability to go into the US, and from time to time, we have been over 30% in the US market. But today, as we sit here, based on a number of factors, which I'll highlight, we're over 90% concentrated in Canada. We have a high conviction portfolio of about 35 names focused on financials, because we think the Canadian financials market is amongst the strongest in the world. We have energy and energy infrastructure, which I think has now come squarely back into focus. And then we've got real estate. And that represents together in aggregate about 80% of the fund. And when we're seeing the types of valuations in Canada today, Annabelle, that we hadn't seen, in the past few decades, we think this represents a tremendous opportunity because number one, we're getting superior levels of income. Our companies are generating cash flow like we haven't seen in the past 10 years because they've really brought down their amount of debt. They've got very mature businesses with really strong moats. So a lot of that cash flow is now being prioritized to return to shareholders in the form of growing dividends. So all these businesses have a history of growing their dividends. Number two, their valuations. When we look at our Canadian market right now and the companies that we own in Middlefield Canadian Income, they're trading today at about 15 times earnings. The S&P 500 trades at about 21 times earnings. And let's just exclude the Mag 7. That's still at about 18, 17 or 18 times earnings. So we're still at a 2 to 3 turn discount to what I would think is our peer group in terms of where these Canadian businesses are most comparable. We're in that mid-cap part of the market, about $40 billion average market cap in our portfolio, and in companies that we think are really well positioned, not only because they're solid fundamentally, but also because we now are firmly in this period where rates are now coming down. And I think that's causing investors who may not be focused on growth, but focused on income and getting an income solution that they were getting from their bank account or from their term deposits are now looking to equity income securities because number one, they pay growing levels of income. Number two, they're attractively valued.